Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. It's generally related to three different topics: wealth building, commodities, and or financial topics. I'll interject my financial opinions as we go through it together. So let's dive in, take a look, see what is going on. If you want to follow me at @Finance, and if you want to join our community, finding-value.com, where I dive deeper into all these sectors looking for potential investment opportunities. We do have a discount coupon code, discount, if you'd like to join. So, bullish trend, got some oil. Bloomberg reporting that Trump's team is preparing additional oil sanctions on Russia, Iran, and Venezuela. And that will increase it's going to lock down the tankers and shipping and all that stuff. It will also reduce oil supply. If it is coming from those areas, it could potentially reduce oil supply to some extent. There might still be some shipping around to certain countries, maybe, but it's trying to lock down on all that. Robert Friedland says Chile has now cut its copper production projection for the coming decade. The top producing nation now expects output to be 5.54 million metric tons by 2032. That is only slightly higher than last year's projection and less than the agency's projection of 6.43 million tons, which was made a year ago. That almost 900,000 ton revision in the long-term forecast is the equivalent of the output of 3 or 4 large mines. And this is for copper. So the way that I view this, and I don't know why people get so caught up in the short term. This is coming, and I don't think there's any answer for it. I mean, people are going to say, oh, well, the price will go up, price will solve everything, and we'll start producing more copper. It's like, have you guys seen the size of the copper reserves that are out there? Have you looked at the ore grades? They're all crappy compared to what we've been mining. It's going to require a lot of money. It's going to be at much higher prices, and it's going to require a ton more energy. And if we do roll over at the same time for oil, I just think, deep down, I'm like, are we ever going to get some of this copper out, or is it all going to be stranded? Is there going to be a lot of things that are stranded in these junior mining companies because we don't have the energy to necessarily get it out? Or are we going to get, we'd have to do small modular reactors everywhere. And maybe that is a potential solution. But I mean, we need to build modular reactors like heck if that's the case. And I don't think it's going to be a smooth transition. But I just look at this and all the fundamentals, copper fundamentals, silver fundamentals, oil's fundamentals, if you take a long enough time frame, they all look like absolute all-star investments. Every single time we've had problems with oil, all of these commodities have run with it. It's like interest rates go up, it puts pressure on the stock market and bond market. Inflation does from the tightness in oil. And then money starts to rotate into commodities. And then that cycle just repeats over and over and over and over. And then we've got fiscal spending on top of it, which is an inflationary push that amplifies any sort of shortages or problems in the market. So fiscal spending by governments running these large deficits and trying to do something with their debt because it's so large. Interest rates are going to amplify the problem where we even could do more deficit spending. And then the shortages of all these different minerals and materials. This is going to be one big bull market. And all you have to do is take a long-term, big picture view and say, yeah, I'm going to ride it for 5 or 10 years, and let's just see where this takes me. It's that simple. Like all of these deficits that we're going to see in silver and copper, and we're probably going to see in a whole bunch of other metals as well in the mid-2020s, it's all coming. And I don't know how they're going to stop this. In some of the metals, I don't know if the projects are there to increase production to demand levels. So obviously price will rise to a demand destruction price, but we're talking about a bunch of elements here on the periodic table. It's not just copper, it's a whole bunch. It could be highly inflationary. Grady says, this is not the time to get discouraged about precious metals. This is the time to be excited. Do not get beat down by the declines or lose interest during them. Understand them, be ready for them. At the service, we have charts that show what is really happening. And he uses charts to gain his conviction. I do too. And we're just kind of waiting for all this money to basically get beat out of the NASDAQ. The bond market's already gotten crushed. And that money rotated, I think, into AI and crypto. If we get a rollover in AI and the NASDAQ and tech, and it may impact crypto as well, then that money's going to seek a new home. I don't know if it will go into the bond market. Maybe they manufacture a decline in the stock market, and maybe people get scared into bonds where they drive demand towards bonds to buy all those bonds that they're basically rolling over. That could be the case if they can pull that off, but they've got a lot of deficit spending, which is for the most part kind of stimulative. So it's a tough market read here, and maybe there is a slowdown, maybe there isn't. It's a tough read with so much fiscal spending going on. Investment Wisdom says define the game you're playing and make sure your actions are not being influenced by people playing a different game. Says Morgan Housel, and that different game, the way that I would define it, is your time frame. Someone who's doing short-term market timing is not on the same wavelength as someone who's playing a long-term investment. What I have found is that the people doing the short-term trading generally don't make any money. In fact, they lose money and then they all quit. And what I mean by all, 99+% of them they never make money and then they all quit. So a lot of them don't make money that are doing the short-term market trading and timing. So I'm in the long-term game where you buy stuff that's cheap, you get that valuation gap between, let's say, the market cap and its fair value market cap. I buy it, sit in it, and wait. And we're just waiting for money to kind of rotate out of tech and crypto, I think, at this point, into something else. Bond market's already rotating. It's already done for, from in my opinion. We're already broken that 40-year downtrend line. It's going on up. That money is not rotating in. Now, gold's behaving very well. We were up 27, 28% last year. So it was a big move for gold, and I think silver's going to partake in it. Copper's going to go up. Oil's going to go up. All the commodities are going to go up. It's going to be a commodity bull market. Now, some people say, well, it's been going sideways for a year or two. That's what markets do in the beginning of bull markets. They go sideways for a period of time. That's called wave two. If you don't understand that it's wave two, you got to look at Elliott wave. You got to read up on some of this stuff and try to figure out why some of these things are doing that. Caution, home buying conditions have collapsed to levels never seen since 1960. Let that sink in. Well, of course, people don't feel like buying homes. Would you want to buy homes with interest rates as high as they are? I wouldn't want to. I'm in my house. I have a low interest rate, and it's great, but I wouldn't want to go buy another one. But at some point, people are going to have to live somewhere, and maybe they rent, maybe they don't. I found renting to be horrible. Absolutely horrible. I hated renting. I feel like they've got all the power and I have no power at all. And if they want you out, they can kind of say, you know what, you need to get out of here by this date. And it's like, oh my God, I don't want to go through that again. I absolutely hated that. So I bought a house, and obviously when I bought the house, it was actually buying conditions were very good up here. But I'll just say this. Um, I didn't want to spend money. I get sick to my stomach spending that amount of money on anything. I mean, so I didn't feel like buying a house, but it was something that I had to do to better prepare myself for what I thought was coming, which is higher inflation and higher interest rates. Grady says miners saw 580% move in its baby bull move for uranium. Because the chart shows that uranium miners have not yet even begun to outperform the uranium price. Posted on the purple backtest, now seeing a higher high after the backtest, which equals bullish. So he says this is URA versus SPUT. This chart shows that uranium miners have not yet even begun to outperform the uranium price, which is what makes a bull market a bull. A very stylish and bullish chart that we've got. We've got two falling wedges there. We have a back test and breakout, so here we go. We got a shoulder head shoulder that has formed, and we're ready to go at any point here. And everyone's going to be left out. And then when it starts to go up, everyone's going to run in because it's the fear of missing out. And that shiny object that everyone chases is the price in a lot of these charts. What a chart. Don't think we are late cycle. We are early. And this is the manufacturing PMI. Look at the jump we have here in 2025. My Lord. That's a huge jump in the Philly Fed IHS, which is generally a leading indicator for the ISM, which is the light blue line to follow behind it. We're actually really early in this move, according to him. So this is very inflationary too. Very inflationary. Could be. It could be very inflationary, put it that way. Eric Nettle says with WTI trading near 80 and 2025 strip, now at 74, very clearly, in our opinion, many energy equities are not discounting current pricing, and they're averaging a free cash flow yield of about 12%, which is pretty good. Lance Lambert says, loan officer, I'm seeing more home buyers with $8,000 to $10,000 mortgage payments. Many buyers who would have gotten 4 or 5K payments a few years ago are now at 8 to 10K. For many first-time buyers, it jumped from 2K to 4K. How much money do these people make? 8 to 10 grand. I mean, that's a lot of money. What is that? 96,000 all the way up to 120,000 a year in mortgage payments. These people are making some good coin if they are taking on payments that large. I'll be honest, guys, I would be sick to my stomach if I had to try to afford an $8,000 to $10,000 mortgage payment. I would feel like I was tied down. Now, an 8 to 10 grand mortgage, I don't know if people are putting money down and what that loan. I'd have to look to see what that loan is, but that's a gigantic payment, my Lord. Breaking 30-year mortgage rates in the U.S. hit 7.11% per Mortgage News Daily, and that's your mortgage rate there. Polymarket is putting the chance of Trump tariffing Mexico, Canada at only 20%. With Canadian crude imports near all-time high, the odds of a tariff on Canadian crude imports is low, in my opinion. So I know a lot of people are talking about tariffs. Some people are asking me, like, what's the impact of the companies? I don't think there's any impact to the companies over the long term. Why would I say that? Tell me where else in the world that we can get heavy oil. There isn't anywhere. So you're kind of stuck no matter who you are. And then what I would do is if I was shipping it and they're going to say, oh, we're going to put a tariff on this. It's like, well, fine, have your citizens pay for the tariff. Done. You're just going to increase the cost of everything. But here's the 4-week average of U.S. imports from Canada of crude oil. It's up over 4 million barrels a day. That's a lot. And then this is, will Trump impose a 25% tariff on Mexico, Canada? It was up over 40% in December, but that's pulled all the way back and we're down to 20%. And right now, this is also causing havoc in a whole bunch of a variety of stocks, I'm sure, as people try to figure out what the heck is going on here. Why do you think uranium sentiment is very low? I don't know why. Maybe because the price hasn't moved and it's been chugging sideways. Most retail investors get excited when the price moves, and then they get frustrated if the price doesn't do what they want it to do in the time frame that they think it should do it in. So I think that's what's frustrating them. The sentiment is bad because we've been chopping sideways in a flag pattern. And they think that it should just go to the moon directly. Um, what you need to do is become a student of the game and just say, you know what, I'm going to do whatever it is. And if you like the thesis, which I like the thesis of uranium, to just stay long some uranium stuff. Um, again, the only thing I don't like about the uranium stocks is that a lot of them are not cash flow positive. They're all very speculative stocks. That's the only thing I don't like about it. But overall, the thesis is great. I think it will go up. Paul says minus 126 billion cubic feet on natural gas versus the 5-year average is bullish in every sense of the word, regardless of expectation, and a situation almost no one understands can't be priced in. What does he mean by and a situation almost no one understands can't be priced in? So I think what he means is when you start to get really low and our days of coverage are incredibly low, the price may be way more bullish than people can think of or even imagine. What happens if we run our inventory levels to a very low level? What price do we need to kill demand? It's not going to be $5. It's not going to be $10 even. We may have to go way up to a price level that people are going to think is ridiculous if we get really cold weather for a long time and our inventory levels reach very critical levels. 1 year, 2 year, and 3 year natural gas strip pricing, Henry Hub is now $4 USD. Structural shift now in North American gas, given the demand for LNG, the gas supply and export, and domestic power demand and global power demand via nat gas. And that is out in the future. You got to keep this in mind, guys. The natural gas companies don't make money when this goes up for short little periods. We want the price to go up, and then we want it to stay up there. And obviously they can, they can hedge production out at $4 USD, some of their production maybe. But they make money by high prices and the sustaining high prices. We don't want it to just rocket way up there and then come down. We want a stable price that's high enough for everyone to make a bunch of money. That is the goal. We don't want to put everybody into a recession. We don't want a big spike in natural gas. We want natural gas maybe between $4 and $6 USD. And we just kind of oscillate there back and forth. We want oil around 90 to 100 bucks. That is where the sweet spot is for a lot of the companies. So we can make a bunch, they can buy back shares, they can pay big dividends. Everyone is happy. And we don't cause a necessary market crash recession. That's the sweet spot. And hopefully it can pull this off here. I just said, holy crap, when I saw this chart. He says the IEA data suggests that claiming we are in an energy race with China is like me claiming I'm in a 100-meter sprint race with Usain Bolt. It ain't a race. Historically, electricity consumption is a great proxy for economic growth. It is used everywhere and hard to store. And look at China's growth in electricity. Holy crap. Ever since 2000, this thing just took off, and it's just going straight vertical, goose. I mean, US is going up a little bit, EU, not really, and India has been going up too. But that is one heck of a move in electricity demand for China. And I just looked at that and said, what the heck is that? That's a hockey stick, baby. Now that's a hockey stick. You got the blade down there, and then you've got the big move. Tourmaline Oil Corp insider buy, Mike Rose, 2,500 shares. This guy has been buying nonstop. Mike Rose is a boss. That dude is just buying nonstop acquisitions as an insider. He's the CEO of Tourmaline, I believe. I think he's the senior officer. Yep. Daniel says weak growth, high debt, high taxes, low productivity growth, and persistent inflation. I wonder why. So the government is spending is now half of the economy in most of the developed world. Look at how much government is spending in the percent of GDP. This is ridiculous. 50%, 38% United States, Germany at about 50%. That's a ton. France at almost 60. What are we doing here? I guess this is fiscal spending on steroids. No wonder we can't get a recession. We're spending 38% of GDP for government spending. Natural gas storage, quick look. So we were down deficit of 258 billion cubic feet versus our projections of minus 245 and 255. The street at minus 259. Storage is now 3,115 billion cubic feet. That's 111 below last year. We are 77 billion cubic feet above the 5-year average. We will have our read on next week's number out tonight. So it's coming out. This is obviously Robert Friedland. His response is, while the world's largest copper producers are sounding the alarm, it will be harder than ever to increase copper production from our primary sources going forward. And the stuff that comes will be more expensive, lower grade, deeper, and more remote, and it's super bullish for copper. The only thing that I question is, how do you play this with an equity? Most of the equities are not great plays in copper. The only way I can view it is like oil, because they're going to use more oil to transport and create these mines, and the diesel that goes into all the trucks and all this stuff. A lot of the bigger companies are fighting depletion in copper and all of their reserves in whatever base metals I'm talking about. The smaller companies have much smaller resources, so they're going to be super expensive. You're going to have a bunch of risk on stuff that's just not worth it. So copper's a tough one to play outside of just buying the physical metal, and there are some trusts that do the physical copper price. Tavi says this is arguably one of the most critical macro developments unfolding today. Even when adjusted for inflation, the 30-year yield has reached its highest level in 15 years. The U.S. cannot sustain this for long, in my opinion. It will need either higher inflation or a suppression of nominal rates to alleviate the pressure. If they do the suppression, they're going to kill the dollar. That's the outcome. And this is U.S. 30-year real interest rates rocketing on up. We have seen most recently a couple of down days, and I do think they're in there trying to buy bonds. I really think they're doing that. It's not the market doing it, in my opinion. That's all I've got for today, guys. So give me a thumb up for the content, subscribe to the channel, subscribe to the website, and we'll see you guys Saturday, that question and answer session at 7 a.m. And that's all I've got for today. So we'll catch you next time. This is Finding Value.